Hey everybody, I hope everyone's doing well and had a good day. This is the overview of the 5-minute chart for the Emini for Wednesday, October 16th, 2024. And let's look at the daily chart first. Here's what we had yesterday. So 2-bar reversal, disappointing bar for the bulls. The bulls hoping for a breakout into a stronger trend, and then we got a big bear bar. And it's an inside bar. We know inside bars are trading range bars. Now the fact that it's a trend bar makes it better for the bears, at least it's not a doji. And I thought we may have had to fall a little further before we found buyers. However, the channel up was tight, and if this is an overall trading range, you expect disappointment after trend bars. And you'll see the majority of trend bars in any trading range gets disappointing follow through. So while I thought we might have fallen a little further, I did think there would be buyers below yesterday's low if we got there. And as far as yesterday's high, it's a bad high 1 at the top of a channel, probably sellers above. Also a bad signal bar. It's a bear trend bar. The 5-minute chart today. We had a trading range on the open. So a bear trend at the end of yesterday. And in general, when you have a trend at the end of a day, going into the close of a day, generally you expect, in this case, within the first 2 hours of the next day, a move that's sideways to up, beginning by the second hour of the day. So even if we did sell off for a couple of more hours, it was more likely we'd start to pull back by 11:30 Eastern time. But here's what we got in this case. Tight bear channel, but then at the end of yesterday, a little bit of an expanding triangle, so breakout mode. We have 3 pushes up, 2 pushes down, and anytime you have 5 legs like this, you know it's a triangle. So 2 pushes down, 1, 2, 3 pushes up. Expanding triangles are one form of a major trend reversal. So in this case, a lower low major trend reversal. You could call it a higher low or even a head and shoulders. Bottom, left shoulder, head, right shoulder. But look at the rally from bar 74 to 77 yesterday. This rally is strong enough to expect buyers below in a second leg up. And on the open of today, we had this bear channel continuing into today. Big bear bar on bar 1, but big tails and relatively small body trading range bar. Bar 2, bear trend bar closing on its low, good for the bears, but mostly overlapping bar 1, and look at the context, tight trading range. And then we started to go sideways. Sell the closed bears on 2, disappointed with their follow through, 3, 4, 5. If you're selling closes down here, you're taking a chance. You're betting on momentum to the downside because you're selling low in a trading range. And if this is your follow through, at some point you sense that there's no momentum to the downside. You buy back your shorts. And the bears know that, and that's what they're doing. And the bulls know that, so the bulls will look to buy. Remember, this needs a second leg. We're getting a deep pullback. That's common in trading ranges, maybe testing the low close of bar 73. The low close in a bear trend, really the low close of a day, is typically support. If you sold the close of 73, you're disappointed by the rally, and any bear who sold down here will look to exit at this price. And again, the bulls know that. And when the bulls see this breakout, they know it's strong enough for a second leg, but they don't want to buy up here at a resistance. They want to buy a deep pullback and then look to capture a delayed second leg. So we test the close of 73, we find support. The market dips below it a couple of times, but unable to break below it, and then we get a give up bar on 7. Bears are giving up, bulls are buying, and then a follow through bar on 8. It's probably always in long on bar 7, but certainly by bar 8. Consecutive bull bars, one being big, both closing on their highs. The context is pretty good. Expanding triangle, so possible major trend reversal. Major trend reversal patterns can develop with less bars, especially on the open of the day, so it's okay to be more flexible with that. And I mentioned the market cycle yesterday, and the same thing applies today. Spike and channel trend. Channels typically evolve into trading ranges. And what does that mean? Well, if the channel began up here, then this whole entire channel could end up being a few legs down in a big trading range, and the top of the range could be all the way up here. So this is a target for traders. The bulls are looking to get up here, and if we do get up here, the bears will look to sell. So good breakout for the bulls. Do you buy the close? Some traders will buy the close, others will wait for a pullback, and others will wait and see what we get. I think it's okay to buy the close, betting on an early low of the day. The context is good, and the breakout is strong. Bar 9, a little bit disappointing for the bulls, but if you judge the strength of 9 as a reversal attempt, you know it's unlikely to lead to a reversal. Any trader who sold down here, let's say you sold above bar 5 or 6, you're trapped on bar 7, and even more trapped on bar 8. One thing that helped me understand breakouts better, I got this from Brad, and I want to share it with you. And for lack of words, what you have to think about is how screwed are the limit order traders. Limit order bears selling down here. How much pain are they suffering when they get this breakout? They obviously did not want to see this. And if they're lucky, they can scale in higher and avoid a loss. And I'll demonstrate that in a few bars. But obviously, bar 9 does not look like it's going to reverse 7 and 8. 7 and 8 still needs a second leg up. High 1 buy, and then a brief second leg, but tight channel. This is a breakout on a higher time frame. Bar 12, this is the close of the 60-minute bar. The day opened here. We sold off briefly, reversed up, closed near the high. This is a fairly strong bull reversal bar on the 60-minute chart. Again, even though we have a pullback below 9 and it's 2 legs up, it's too tight. Plus the market likes symmetry, so this could all just be one leg. We may have to get a more complex pullback before a big second leg, similar in size to this rally. A little bit of a surprise on bar 14 and follow through 15, but the context is bad for the bears. Remember what I said about the limit order traders down here? And there's other breakout points. There's layers of support. Traders who sold above bar 4 also got trapped on this breakout, and that's actually just about where bar 15 tested. So any trader, let's say you sold above 6 and you sold more, below a bear bar, 9, used a wide stop, assume you don't get stopped out, or you sell below the reversal bar, 12. However you sell again, traders who sold down here and used a very wide stop were able to scale in and avoid a loss, but 15 did not quite get down to the high bar 5 or 6. We tested the breakout point of bar 4, and that was enough. The bears took it. So again, why is this support? Because of trapped traders. If you sold for any reason, or if you're short for any reason and you get this breakout, and you're a bear, you're trapped into a losing position. And if you're a bull, the odds are you did not buy above bar 6. And if you did, you probably were not very eager to do so. It's a small trading range bar in a tight trading range. The context was okay to bet on a reversal, but not a good stop order trade above 6. So this trapped bulls out of a winning trade. What does that do? We have an imbalance. We have support below the market. The price is up here, but traders don't want to buy up here. The risk is too big. Think about the trader's equation. If you're buying and your premise is that we're going to get higher lows, possibly a bull trend, you can put a stop below 7. But do you really want to buy the close of bar 12? Your stop is all the way down here. And if you buy the close, your 1-to-1 risk reward is all the way up here. And while the target is reasonable because it's near the top of the channel, it could be the top of a trading range, the risk is simply too big. Bulls who bought down here are going to start taking profits. Bears, maybe they see 3 pushes up on 71, 77, and bar 12. We have a bull channel line, so resistance for that reason too. The risk is big and there's a bull channel line. So what do? We pull back sharply. This is a vacuum test of support. This is probably more due to bulls stepping aside and setting their limit orders down here more than it is bears selling aggressively. Big up, big down, trading range likely, but remember, this needs a second leg up. This still may need a second leg down, but we are testing a breakout point where a lot of traders got trapped, and you can see the reaction. The high of bar 4, 58.25, the low of 15, 58.5. So this bar 15 low is 1 tick above the high of bar 4. We just missed it, and we start to reverse up. Inside bar closing on its high, and then follow through. So if you're a bear and you're expecting a second leg down, well, now there's a problem. The rally from the low 15 to 17 needs a second leg up. We pull back briefly, and if bears are lucky, if they sold the low close of 15, now if you think about it, you sell the close of 15, 16 is your entry bar, market goes against you immediately, then goes even more against you. You'd be happy if you can get out at break even. Obviously you made a mistake. You sold at a breakout point after a pretty strong bull breakout. Market came close to your entry and began to reverse up. Did 15 make the market always in short? I don't think so, especially because it's a trading range. And you could even call it a bull trend. We're getting a bull channel, higher highs, higher lows. So as big as 14 and 15 are, and it's consecutive bear bars, you're still above the most recent higher low. And again, it could simply be a vacuum test of support. And then when that's your follow through, you know there's something wrong with the bear breakout. So we might still be always in long at this point. Then you get a second reversal up, probably always in long. We start to drift up. Possible double top with 12 and 27, maybe 3 pushes up here, but bad signal bar 27. Collecting bars above the moving average 28 might simply be a vacuum test of the bad signal bar 20. So 20, bad stop order signal bar. But then we get the breakout 21 and follow through, and we get a small spike in channel trend. And again, remember the market cycle. You get a breakout, pullback, and then a channel. That channel evolves into a trading range, and we test all the way back down to the start of the channel here. And then sure enough, there's support, the bad signal bar, and the market cycle. The bear's hoping for a double top, 33, but 4-bar micro channel, doji signal bar, not ideal. Same with 37, trying to get a double top with 12, but not enough selling pressure through here. Fairly tight bull channel, and a lot of bars above the moving average. And then breakout 41, 42. Bull's hoping for a measuring gap. It's either a measuring gap or an exhaustion gap. And you can start with the more conservative Measured move, maybe from the 15. If you want to go really conservative, maybe from the bar 30 low to the breakout point. Here's your measuring gap target. The next one, maybe from 15, and then all the way down here, maybe bar 7, takes you up here. So target's above, and we have a spike in channel trend. We're getting follow through. So the bear's hoping this is an exhaustion gap, and we get a reversal, not getting much selling pressure here. Reversal attempt 44, but probably minor, testing breakout points. Here's a breakout point, the 37 high. And we got a two-legged pullback, and we found support in this area. We go sideways to up, and the trend resumes. Trends always look like they're reversing, and they never, the width trend entries never look all that strong, and bad signal bars work. You could buy above 47 and the trade went your way. And if we look closely, let me see. Here's a negative gap. The bodies do not overlap. The reason I'm using bodies, and I say negative gap or body gap, because traders who look at the line chart, if you think about the line chart plots the closes of the bars. So you don't see the tails. So there is an open gap here. And if you look down here, of course, earlier in the day, there's a gap there as well. And a fairly tight bull channel, always in long. It takes a lot to reverse the market when it's doing this. You need big consecutive bear bars, you need a strong trend line break, and then a retest of the trend's extreme. Until you get that, traders will hold long. 59, an upside breakout. Remember, this red line is the start of the channel from yesterday. So we're getting a buy vacuum test of resistance, possible exhaustion gap, but it also could be a measuring gap. And if it is a measuring gap, you could start the measured move from here to here. There's your target. We're already very close to that one. Then you can start extending the target. But because yesterday was such a big bear day, I suspect that there are sellers at the midpoint of yesterday and in the upper third of yesterday. So the upside here might be limited. We're getting the biggest and strongest looking bull bar in at least 30 bars. And that's characteristic of exhaustion. So the upside here might be limited. And then 60, high one buy, but context not great. Possible exhaustion gap, and right below resistance, the start of the channel. So this could be the top of the trading range. We trigger the high one and then immediately reverse down. I think it's okay for always in bulls to exit below bar 61. It's a little aggressive to sell. Remember, you need less reasons to exit a trade than to initiate one. And then 3 consecutive bear bars. 63, trying to reverse. You can call it a high 2. High 1 above 60, then double bottom with 60, 63. However, we're still on the exhaustion gap, and bears will sell the close of bar 59. Stop up here, betting that we'll test the low of bar 59 before we go up to a measured move of bar 59. They're betting this is exhaustion and the start of a trading range. Exhaustion gap doesn't necessarily mean reversal, but it means more sideways. So 63, good looking signal bar, but the context isn't great. We might be at the end of a trend, and the high close 59 is now resistance. Any trader bought the close 59, disappointed with their follow through, they'll probably look to take profits on longs if we get back up here. You can see we came close to it but reversed back down. and then a second test, but now possible double top, lower high, and we're drifting sideways to down. The odds are there will be buyers at the moving average. We haven't touched the moving average since bar 47, but again, because this was exhaustion, there's an increased chance we fall down to the low of 59. But the downside is probably limited after this rally, and this is more likely a tight trading range. Most breakouts will fail. And you can see mostly sideways into the close there. Stop order trades today. You probably buy above bar 7 and buy the close, or buy above bar 8, but use a wide stop. And if you're buying up here, it's really not ideal. You're using a wide stop, and it's likely the market is going to pull back. So not really ideal to buy here. If you're buying closes, you need momentum. And if you buy the close of 11 and you get bar 12, it's a follow-through bar, but it's weak follow-through. Why are there sellers into the close of the bar? And why did the bar close below its midpoint? And then 13, an inside bar. Because it's an inside bar, it's a small trading range. So on a smaller time frame, this is a possible final flag after 2 legs up, so you can get a deeper pullback. However, not a great sell below 13. And then as far as selling 14, I would not. You're selling about a 50% pullback of the rally. So if you're selling here, you're selling at what is probably support. You could buy above bar 16, but after 14 and 15, probably better to wait for a second leg sideways to down. And here was that second leg sideways to down. So if you wait for that second reversal, 16 being the first reversal up, the second reversal is above bar 20. It's the bare minimum for a buy signal. It's a buy reversal bar. So even though it's a bare body, the bar closed above its midpoint. So you could buy one tick above 20. Other traders will wait for a better signal bar, but it wasn't all that easy to get long here. Bar 21, fairly big bar, and prominent tail on top. And you're buying in an area where the bulls just got trapped, so not easy to get long here. But here I mentioned the spike in channel, and then the channel evolved into a trading range. We're testing the bad signal bar 20 over here, so a better buy above 30. It's a double bottom and possible bull flag. The market is creating higher lows and higher highs. And I also mentioned earlier, I'm not sure the market was always in short here, maybe briefly, but probably flipped back to long on 17. And if that's the case, you can buy above any bar closing above its midpoint here. And the management style, one fairly simple style of management when the market is always in long, is you get out below a reasonable sell setup. And I can talk about a few of those. For example, I thought it would be reasonable if you're long to get out below 27, even though the signal bar is not all that strong. It's 3 pushes up, possible lower high double top. But if you do exit longs here, you buy again above a bar closing above its midpoint. So you exit below 27, but get long again above 30. And then maybe you exit below 37, not all that strong, okay to hold. But if you do, you buy again above 38. And traders can do that all the way up. Okay to buy the close 41, 42, but 42 is significantly smaller than 41. And that it makes you wonder, where is the momentum if you're buying the close? 42 is a good looking bar, but it's less than half the size of 41, and then even weaker follow through 43. So buy the close, traders exit, and traders instead look to buy a pullback. 2-legged pullback, high 2 above 47, you could buy above that bar. Still always in long, buy above any bull bar. And once you get the possible exhaustion gap on 59, I mentioned it's reasonable to exit longs below 61, and it's aggressive, but you can sell below 61. And that's about it for stop order trades. There are some fishing entries in here, like the high to above 63. Traders might buy, taking a chance that we get a strong upside breakout, but when 64 is the entry bar, you see the market's in a tight trading range, the bulls will just bail out of that trade, and that happens back and forth. Possible double top, low 2 below 65, but bad entry bar, the bears will exit. Back and forth, 68, same thing, traders will buy above, but bad follow through, they get out. And then for limit order trades today, there's a limit order buy down here at the low close of 73. I mentioned that one earlier. Sell the closed bears, disappointed, strong enough rally for a second leg, two-legged pullback, and you're buying at support. So you set a limit order at the close of 73 or one tick above 73. Get filled on bar 4. And then bull breakout. There's a limit order buy at the breakout point of bar 4. And if you had it right at the high of bar 4, remember the market went one tick above the high of bar 4. So you would have had to set your limit order 2 ticks above the high of bar 4 to get filled on 15. Low one short below 19, but 5 bar bull micro channel. Not the strongest micro channel, but more likely buyers below and a deeper pullback. And then there's a short at the bar 13 low because 14 trapped traders. So this is the logic behind bad signal bars and trapped traders. We see it all the time. It happened here on bar 6. It happened here on bar 13. Is 13 a good bar to sell below? Not really. It's a tight channel and it's a bull bar. Plus, it's an inside bar. Really reduces the chances you're going to get any strong breakout. But then you get 14, and that's a surprise, and follow through. And that creates resistance up here at the low of 13 and 12. So what happens? The market, we get a buy climax, pullback, buy climax, and then smaller buy climaxes testing this area, and the market sells off briefly. Traders who were trapped up here, getting out, and this is getting a second leg sideways. And then there's the limit order buy at the bar 20 high. I mentioned that one earlier as well. Bad signal bar 20, but there's a bull breakout and follow through. Traders can set a limit order to buy here. They get filled over here. 33, double top, but 4 bar micro channel and doji signal bar, probably buyers below. And all of these reversal attempts are weak. You could buy below any bar. And there's a limit order buy here at the bar 40 high, another bad signal bar that resulted in a breakout and follow through. Set a limit order here, you get filled here, 2 legs down, and you're trading with the trend. Bad reversal attempts here. I'm not sure any of these triggered. This looks like a micro channel all the way up until 55. And 55, tight bull channel. Maybe you can argue 3 pushes up, but whenever you can always argue there's a wedge in a bull trend, but when the channel is tight, it's really not ideal to look to sell, especially when your signal bar is a doji. So buyers below here. High one buy above 60, but bad context, probably sellers above, and then limit order market through here. Traders buying below any bar, selling above any bar, and if they're scaling in, they're making money. All right, that's all the time I have for tonight. Thanks everybody for watching, and I hope everyone has a good night.